Hi friends. Are you curious about Forex trading but feel a little overwhelmed by all the jargon? Commission, spread, swap. What do these even mean? Well, don't worry. Today, I'm here to break it all down in simple terms, so you can trade confidently without feeling lost. Let's dive right in. Commission first up, commission. This is basically a fee your broker charges every time you make a trade. Think of it as a ticket fee for entering the Forex market. Some brokers charge a flat rate, while others take a percentage of your trade volume. Pro tip: look for brokers with low commissions, especially if you plan to trade frequently. Those fees can add up fast. Spread. Next, let's talk about the spread. Imagine you're at a currency exchange booth at the airport. They buy at one price and sell at a slightly higher price. That difference is the spread. In Forex trading, it's the same thing. It's the gap between the buying, bid, price, and the selling, ask, price. A tighter spread means lower costs for you as a trader. So, always keep an eye on those spreads. Swap. Finally, swap. If you hold a trade overnight, you might earn or pay a small fee. That's the swap, also known as rollover interest. It depends on the interest rate differences between the two currencies you're trading. For example, if you're buying a currency with a higher interest rate than the one you're selling, you could earn some extra cash. But if it's the other way around, you'll pay. This is especially important for long-term traders to consider. So, there you have it. Commission, spread, and swap. 3 key costs you'll encounter in Forex trading. Understanding these can help you make smarter trades and keep more profits in your pocket. Remember, every little bit counts when you're building your Forex journey. If you found this video helpful, smash that like button and subscribe for more trading tips. Have questions? Drop them in the comments, and I'll see you in the next video. Until then, trade smart and stay confident.